Hey folks, how you doing? It is Thursday, November 21st. A week until Thanksgiving. Yeah. So this is going to be a short video just because the only thing really that I can point to that stands out, very, very starkly, is that the fiscal flows are extremely strong. Extremely strong. Okay, we're up 137 billion over last year. And if I make the adjustment, because there was like kind of a calendar issue at the beginning of the fiscal year 2024, that was October 1st, 2023. If I make that adjustment, we're still up something like 82 billion in leading spending flows over last year. And like last year at this time, spending was up like around 52 billion over the previous year. So this is very, very strong. And under these conditions, you're just going to see stocks going up. You're going to see commodities going up. You're going to see gold going up. You're going to see silver going up. You're going to see Bitcoin going up. You're going to see oil going up. All these kind of reflation trades. I don't think the bonds are going to collapse. I think now they've done most of their discounting of the Fed pausing, okay? Because I think that's what's going to happen now. The data is just going to end up being very strong. We do have, as I've been saying, a very small decline in T-bill interest income transfers. About I think it's like 6.5 billion. And total interest income transfers are like flat compared to last year. Okay, so that's not really contributing anything new. But overall spending is it's zooming up. Okay, nothing else I could tell you. It is what it is. I was expecting to see more of an impact, or let's say more of a decline in interest income transfers. And we may still see that. It's just a slow evolution on that stuff. But the general spending, all the general line items of spending, Social Security, defense, Medicare, Medicaid, education, federal salaries, you name it, the whole gamut. Those are just strong as hell. You're not going to get an economic slowdown. What's interesting, though, is that the forecast for GDP growth is still like 2.5. This is the thing. If I really sit back and think about this is like kind of incredible. If you talk about the swimming pool analogy, which I did the other day, and I said, the metaphor I used was like, you got a fire engine pumping at full capacity into that swimming pool right now. I'm not even talking about a pipe with some water coming out. I'm talking about a full-blown super pumper fire engine putting water into that swimming pool, and we're growing at 2.5%. Where this kind of spending years ago, if this just happened suddenly like it did in the COVID era, when it jumped up from like 4 trillion to 7 trillion, we were growing at 20%. So it's pretty amazing. Now, don't forget, a lot of that is being taken back in the form of taxes. If you want to talk about net spending, that's a whole different ballgame. But even that is up significantly over last year. So net spending, that's what that's what remains in the swimming pool. After the water is pumped in and then there's a drain at the bottom, which is taxes, that's the level, that's net spending. But even that is up significantly. I think it's up something like 170 billion. If you do an adjustment on that, it's like up 90 billion over last year. So 90 billion net addition to the economy in a very short period. You know, we're not even 2 months into the fiscal year. So, I mean, you can't go against these flows, okay? Now, there will be a tax drain in December. Usually it's not a very large one. It's a quarterly corporate tax drain in December. And so we might get a little bit of a pause in the rally. But with these kind of flows, I mean, it's just, you're in a bullish environment. And that's all there is to it. And so every time the market opens down, like now we got a lot of crazy shit going on with, you know, Russia, Ukraine, and the Middle East, and the transition, and what Biden's doing, and we got a lot of crazy stuff going on. Like I don't get into that. Don't think I don't think about it. I think about that a lot. Like every sane person thinks about, you know, are we going to be around much longer with these lunatics in Washington? But I'm sticking to the economics. Every time there's a dip in the market, you know, open up 300 down or 200 down or whatever, you got to buy that. You know, stick to good stocks, stick to the big names. When they sell them down, you buy them. You add to your holdings. We are in a positive monetary environment. And when I say monetary, I'm not talking about monetary in the way monetarists think about it. Here's another thing that I just, you know, that made me think about something. The Fed, remember, I mean, right now the Fed's balance sheet has fallen below 7 trillion. This is like the first time in almost 6 years that it has been that low, okay? It got up to almost 10 trillion. It was high 9 trillion something. And that's when the Fed said, you know, it was going to start reducing its balance sheet. And all these monetarists were saying, oh my God, that's going to be it. That's going to be the end. You know, they're draining the system. It's going to be terrible for stocks. It's going to be terrible for the economy. I was the only one who said that absolutely that will not be the case. I said that's going to be a positive because what it entailed when the Fed, quote unquote, reduces its balance sheet is simply it lets those interest earning securities that the Fed held in its own account, those securities rolled off into the economy, and that allowed the economy to earn that interest as opposed to the Fed earning that interest, which is like, that went nowhere. It was on the Fed's books, and the Fed just turns that over to the Treasury. So that the entire time when the Fed was increasing its balance sheet, it was literally draining those higher interest-bearing securities from the economy and holding it for itself. Ridiculous. So all these people, it's another thing that I have to point out. Remember, I always say we're going to go back and we're going to revisit the things that I told you. And I told you at the time, Fed reducing its balance sheet is going to be very, very bullish for the economy and the stock market because it will allow those higher interest earning securities to remain in the economy. And that, you know, all it was a transition from that money flowing to the Fed, okay, instead of the Treasury paying the Fed, which is like one part of the government paying the other part of the government, The Treasury now paid that money into the economy. But all of these monetarists were saying it's the end of the world. It's going to be terrible. It's going to be horrible. It's going to be the end of everything. It's going to cause a market crash. It's going to drain take away the punch bowl. All of that nonsense. None of that happened. And I told you that's exactly how it was going to work out. And I'm telling you now, well, the problem now is that the Fed is going to stop cutting rates. I don't think they're going to raise rates, but I think they're going to pause because these fiscal flows are very strong, and it's going to lead to a rebound in the job numbers, a rebound in economic growth, and they're going to look at that and they're going to say, well, we don't need to cut anymore. So my whole premise for the remainder of this year and going into next year was that these cuts were going to reduce these interest income transfers. We're not going to get these cuts now, at least not in the near term. Unfortunately, or fortunately, however you look at it. I mean, I have a bond position on, so that's kind of unfortunate for me. We may get one more cut in December, but after that, the way it looks right now, and again, we got, listen, folks, let me end off with this. I know a lot of people right now are making bets on the Trump presidency. Reflation, tax cuts, there's a lot of unknowns. Okay, the whole Doge thing with the Elon and Ramaswamy. There's a lot of voices out there now, more, and there always has been. Let me just say this: there always have been a lot of voices of people saying the debt. We got to deal with this, the debt. These debt phobes who don't understand anything. But I have to say, like right now, it seems to me. I don't know, maybe you're seeing the same thing, maybe not, but it seems to me that this debt phobe mania is reaching some kind of a crescendo, and it's kind of evident in the fact that Elon Musk has been appointed as this government efficiency spending cutting czar. And a lot of people look at Elon, the most important person of all. Trump himself looks at Elon. He's the number one advisor by far. I read a thing today saying there's nobody even close in Trump's transition next to Elon. Nobody even close to his, status when it comes to advising Trump. And he's all about cuts. So I don't know what's going to happen. But I have to say that it seems to me that we're reaching some kind of a crescendo in terms of the voices screaming and demanding something done about the debt, these debt phobes who don't understand anything. To me, that's a ticking time bomb. I don't know if it's going to come to pass. I mean, I heard somebody yesterday say, gee, I don't know if we can do it without cutting into entitlements. There you go. Social Security, Medicare, Medicaid. You start playing around with that stuff and you're talking about a sea change, a massive, massive change in the fiscal picture, which is not going to be something that works itself out in a few months. You're talking, if they start messing around with that stuff, you're talking about years and years of really, really difficult economy and stock market that goes along with that. Anyway, that's it for today. Please like and subscribe if you've done that already. Thank you very much. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. Thank you. See you tomorrow. Bye.